Hello and welcome back. Let's welcome in the management at HPCL. MK Surana, CMD at the company, is now with us. Mr. Surana, thank you so much for taking out time for us. Always good to chat with you. Could you just first start by, what happened in the budget for the oil sector with the cess increasing? How does it impact the volumes, if any?
So good morning to you. As far as the budget is concerned, there are two things. One thing is increase in the special additional excise duty and road and infrastructure cess each by 1 rupee. So that definitely makes the petrol and diesel prices costlier by around 2.5 rupees per litre in the market, including the VAT, etc., which is applicable to that. But because it is a pass-through cost taxation, so to that extent it will be neutral to the oil companies. The second thing is there is a stimulus for EVs in terms of reduction of GST and 1.5 lakhs allowed as a deduction which is paid for borrowing for EVs in interest. So that may give some motivation for the electrical vehicles, but still in country the electrical vehicle penetration is very minuscule. So to that extent, I do not think that there is a substantial impact of this budget on the oil industries per se.
Well, a far concern, but what about the slowdown? Is that hurting fuel sales, Mr. Surana? Yeah,
can you repeat the question?
Sure.
I lost
in terms in terms of the slowdown in the auto industry, how has that hurt sales?
So as far as if we see April to June data, the MS sale has been good. I think MS growth was in the range of 10.8% for April to June quarter. The diesel was slightly lower, it was around 1.4%. But the reason is in the passenger vehicle segment, there is a shift from HSD vehicle to diesel vehicle to petrol vehicle. And of course, there was a election season in April to June and more passenger vehicle being in the petrol sector. So there was a good growth of petrol, and that is on the back of a very strong growth last year during the same period of almost 15%. So the petrol growth had been good, but the diesel had been slightly sluggish. But I can also attribute it to something to slightly delayed monsoon, so which will impact the agricultural activities to some extent. And slowly and gradually, as we are going towards lesser and lesser power deficit, the diesel which goes in power DG sets, etc., that consumption reduces. So if you are asking specifically whether the 2.5 rupees increase because of the budget, whether it impacts the consumption directly, I don't think so, as far as the crude prices and the product prices remains moderate and affordable.
A big concern in the market is that the cycle of your GRMs is likely to continue to remain subdued. What is the sense that you're getting after several months of seeing a downtrend? Will there be an improvement in the GRMs?
We expect the second half of the year to have the better GRMs because it is expected that the diesel crack will improve, and that should help the GRMs in Indian refineries, which are more dominant diesel producers. Basically, it is on the back of IMO implementation, and we are hoping to have quite a good increase in diesel cracks.
Right. Can you also just talk to us about the expansion projects at Mumbai and Visakhapatnam? Are they on track for completion in FY21? What will be the total capacity after that?
As far as Visakhapatnam is concerned, we are adding from 8.33 to 15 million metric ton, and that project is likely to complete in FY21. As far as Mumbai refinery is concerned, we are adding 2 million metric ton from 7.5 to 9.5 million ton, and that we are hoping to complete in this financial year itself. And both the projects will make the refineries compliant to BS6 fuel production But as far as BS6 is concerned, both the refineries will be ready this year itself to be able to produce BS6 petrol and diesel to roll out from the due date, that is 1st April 2020 right now.
Mr. Surana, do you see non-fuel retail becoming a bigger contributor to financials? For example, the lubricant segment, is that witnessing better growth? I mean, how do you see trends shaping up going forward?
So, as far as HPCL is concerned, we had been a dominant lube supplier in the country, and that segment had been doing good, and we had been recording good growth in that segment. If we see April to June period, we had a growth of around okay, I don't have the figure right now here, but our lube is doing well, and that is a good contributor to our profitability, and that continues to be so. We have got an advantage that because we are also the largest producer of base oil, having the lube refinery, and we are also the market leader as far as the lube and finished goods are concerned. So that will continue to be so. As far as the other products are concerned, of course MS and HSD is a volume contributor, but in the profitability it forms certain portion of the total volume, total profits. So other businesses will continue to that extent, and in future gas and petrochemical will also be the product lines in our business portfolio. So slowly and gradually we will have a much more diversified product range.
Right. When I just look at HPCL versus others in terms of network, in terms of loyalty program, in terms of aggression, it's much higher than peers. You think that will be the differentiating factor? So whatever the industry growth is, you will be higher than that because of these factors or this strategy?
Actually, HPCL had been a bit agile in our marketing setup, and we had also over a period has put good infrastructure to have the logistic efficiency, to have the cost advantages, and we have consistently built it in, whether it is the pipelines, whether it is the other infrastructure is concerned. Pipelines gives us the logistic advantage. We own the second largest network of cross-country product pipelines in the country right now, around 3,500 kilometers, and we have got certain further pipelines are also coming up, and that helps us to that extent. In terms of marketing also, we had been quick to adopt the changes in the market and respond to it. And the market behavior is also changing, and we will always be on track to ensure that we respond to the needs, we respond to the customers, and we are able to give them the experience which make them come to us.
Your current level of debt right now, and what would you say to analysts who are fairly concerned that your leverage has a tendency to go higher from here?
We have a capex cycle which should increase our debt to some extent, but whenever we take up any project, we have the evaluation of the project, the returns, IRR, debt equity ratio, capital as far as the DSCR, etc. is concerned, and we are comfortable with the debt equity ratio which we are likely to have even at the peak of the debt. The good part is that all of our projects have got quite a clear visibility, and they will be completing and commissioned progressively in next 2-3 years, and therefore these are not the projects which is very long term horizon of 5-6 years. They are 2-3 years, 4 years maximum in future. Marketing projects have got still a shorter time required to complete the projects. So we are okay with the borrowings or the debt which we need to take, and we are tied up for all that. So while on the face of it may appear, because we had operated with a lower debt to equity ratio, and in the last 3-4 years we made consistent efforts to reduce it further with the improved internal generations and the profitability, and that's how we have taken back on the back of it our growth plan and the projects, and we are quite confident of handling it.
All right. Thanks for joining us, Mr. Surana. Good chatting with you as always.